There's a lot of different ways to invest and profit in the stock market, and each comes with their own unique advantages, risks, and requirements. Clarity of thought and purpose is absolutely critical to your success. Knowing clearly what process is likely to deliver the outcome that you want. In this video, I'm primarily going to be focusing on active versus passive investing and using income generating strategies to create regular cash flow. Broadly, there are two paths that you can follow. Let's look at each one of those. First of all, the various avenues that you've got if you want to be a passive investor is that you can just leave it to a fund manager. The performance is self-reinforcing in a way, because when markets are going well, then people tend to put more money into passive funds. Which means that the fund manager then has to go out and deploy those funds according to their rules. And so that means that you're often buying stocks when they're near the top of their trend. And so you're paying often more than you need to. So that's one of the issues with a fund manager. And of course, on the other side of things, when the market goes into a decline is when a lot of inexperienced investors want to redeem their money because they get scared, and so their fund managers are forced to sell out what might be good quality assets at a low point in the market. So part of a fund manager's or your typical fund manager's operation involves buying high and selling low, and that's why the long-term returns from passive fund managers tends to be fairly lackluster. Now, the other way that you can engage in a passive investing style is to not pick individual stocks, but to buy a selection of exchange-traded funds and just hold them long-term. And there's nothing wrong with that. But again, you've just got to be clear on what your expectations are for the sort of return that you're going to get. And if you buy ETFs, then you remove specific stock risk, because you're buying a basket of stocks, and so they will tend to be less volatile. But by nature, in an ETF, you're going to have some good stocks, and you're going to have, at the other end of the spectrum, you're going to have some very ordinary stocks. So you are buying a cross-section of different quality and value. And of course, holding long-term, I have a real problem with anyway, because I think markets are so volatile these days that we are going to get periods like we saw in 2008, where markets go through very, very significant corrections, and that's very tough for most people's psychology. The other way that you can be a passive investor is to just buy the household names. So in the Australian context, you can buy the banks, and you can buy Wesfarmers and Telstra, and just buy all the big established names that consensus thinking says that that's what you should buy. The problem with consensus thinking is that it's wrong most of the time. So if you just buy the household names and hold long term, I think that's quite dangerous as well for any number of reasons, and one that I just mentioned a minute ago, and that's that periodically we are going to see severe bursts of volatility. And whilst a lot of investors go into that thinking, well, I'm not going to sell, I'll just hold, the reality is that most investors do panic and sell, and they sell after there's already been a significant fall in the market. So often they're selling at the worst possible time. So that's passive investing. Let's look at the active investing avenues that you have at your disposal. The first one is that you could follow a newsletter, and there are good newsletters and there are very poor newsletters. Putting that aside, often following a newsletter doesn't work very well because of ill discipline. And I've been observing investors over many decades, and they just tend to want to play whatever is doing well at the time. And of course, any investing newsletter or any fund will have periods where it will do well and periods where it won't do so well. And so investors tend to flip-flop from one to the other and never really stay on a consistent path So I think following a newsletter is generally a way that doesn't work out too well for most people. The other option you've got, of course, is to become your own fund manager with some sort of assistance from external information sources. And if you still work, I think that it's highly unlikely that you can do what is needed to be an effective fund manager on your own. I think at the very least you need some assistance with information and perspective. And the reason that I say that is there's a number of elements to it. Firstly, you need a broad understanding and a view of what is driving markets now and for the next 6 to 12 months. And if you don't have that, then you're making investing decisions completely without any context of what's going on in the broader picture. Now, to have that broad understanding and view, it requires staying up to date with global stocks, with bonds, commodities, and also understand the interrelationships between those various asset classes. Now, there's no great magic science about that, but it just takes time. You've just got to do a fair amount of consistent reading. And most people have neither the time nor the inclination to do that reading to stay up to date. The second thing you need to do is to stay close enough to the market action to be responsive as needed. And again, I find that through observation that investors sort of wax and wane in terms of their focus on the market. Thirdly, you need to be decisive enough and have the conviction to buy and sell against the crowd, because if you want to buy and sell with the crowd when you feel comfortable, then you will be buying closer to the top and you'll be selling closer to the bottom. The only way to outperform as your own fund manager is that you've got to go against the crowd. And for most people, that's extremely difficult to have the confidence to do that. Next, you need the skill to be able to properly analyse a company's balance sheet, their cash flow statement and their P&L. You need to be able to recognise good management that uses capital efficiently with shareholder benefit as a priority. And just too many boards run the companies for their own short-term benefit objectives. And as a consequence, they often destroy shareholder value over time. It's amazing how many companies don't actually enhance shareholder value as the years go by. And finally, you need, at least at a basic level, the skill to be able to read charts, as I said, even at the most basic level. And I'll just give you an example of what I mean by that. This is the S&P 500, the main index for America. And this is the context that I'm talking about at the moment. As you can see at the time of recording this video, the S&P 500 index has been rising since early 2016 and has risen very strongly. And you can see at the moment that the blue line, which is the 50-day moving average, and the red line, which is the 200-day moving average, are diverging, which means that the trend is accelerating. Those two lines are getting wider apart. And there's no real wild swings up here that's indicating a change in character of the market. So at this point in time, the context is that there is no, the market is not showing any signs of reaching a near-term top. And that's the context in which you need to be able to make your investing decisions. Now, that analysis is simple, it's visual, and anybody can make it at any point in time. But the second thing that you need to be able to do is you need to actually be able to or acknowledge what it is that you're seeing. And that's where a lot of people break down because of what they read in the press. That tends to put a bias in their head, and they can, whilst they might look at this chart and see a chart that's advancing very nicely, there's a whole lot of other information that's in their mind that actually prevents them from acknowledging that. So they're all the key elements that you need if you want to be your own fund manager and you want to do it all yourself. And that's why I think for most people, It's okay to be your own fund manager, no problem with that, but you're going to need assistance with information and perspective. Now let's look at active investing and break that down a little bit. So first of all, you should really consider your investment style, and there's a couple of major investment styles. The first one is what's called a top-down analysis. It's based on big picture themes, or alternatively, you can do what's called a bottom-up analysis, where you start with the individual stocks to determine quality stocks and the value of that stock. Now, I think in reality, you need to do a bit of both. You need to do the top-down so that you can get the context in which you're making investment decisions. And then you need to do your individual stock research to identify the best stocks that are available and know what price equals value. And next, you need to try and buy with a margin of safety. So ideally, be able to buy below what you assess to be fair value, because if you consistently pay too much to buy a stock, then that's going to be a really big penalty for you over the long term, and it's going to severely hamper your investment objectives. Now, turning to the macro theme investing, I just want to make a couple of really important comments here, because it's very easy to read something about a macro trend that's unfolding over the next 5 years and get really excited about it, and that macro theme will probably play out over that time period. And it is important to be in tune with the big trends, but they may take years to unfold if they're a new trend. And that's why you want to be able to determine what is a trend that is now actually established and is not one that is still in the process of unfolding and may take another year or two to gain traction. So it's very important. Macro theme investing obviously is helpful, but it's just the first cull. You then need to identify what are the best sectors that are going to be the beneficiaries of those macro trends, and not just start with the stocks first. So some very important things to remember about macro investing. Now, looking at the bottom-up style, which requires really detailed individual stock research, and that's what I was talking about earlier with respect to being able to analyse a company's balance sheet, their cash flow statements and P&L, and you've got to be able to access a database that's going to give you all that information, because there's no point in just looking at the last set of data. You've got to look at trends in all those things over time. We want to focus on the best stocks in those macro theme sectors. Why invest in a poor quality stock? Why not just buy the best? And you need a minimum of 3 to 5 years of that financial data. Otherwise, you're just making decisions that again they're not based on the proper context. Now, valuation matters in the longer term, but short-term price can be overridden by sentiment swings and irrationality of the market. That creates opportunity, and having an understanding of valuation also avoids you paying too much, and that's really important. Now, on the other side of things, we can look at income generation. So the first part of what I talked about was really a focus on the capital side. Let's look now at income generation and some important aspects to remember. It's total return that matters, so capital gain plus dividends. And again, I just speak to too many investors who are just focused on dividends and don't even think about the fact that they might incur a capital loss, which might take away several years of dividends. So always look at total return. Don't just look at dividends, because that can be very dangerous. Very dangerous because, as I said, you can lose quite a lot of years of dividends by a capital loss for a stock that goes into a downtrend. And in Australia, you've only got to look at Telstra to be able to understand that concept. And also, dividends are not guaranteed. Just because a company is paying a certain level of dividend at the moment doesn't mean that the company is going to be able to continue with paying that dividend. Also, quite a lot of these dividend type defensive stocks are far more sensitive to interest rates than other types of stocks, and so that just brings another element in there that you may not have considered. Ignoring the potential to make capital gain by buying below fair value is a wasted opportunity. If you don't consider the opportunity to maybe pick up 10 or 15 or 20% capital gain by buying below fair value, and I'm very prepared to accept a much lower dividend return if I feel I can get a much greater capital gain. What to look for when you are looking at dividends? First of all, you obviously need to make a determination about whether that dividend can be sustained. So you can look at something called the payout ratio, which gives you a margin of safety. If a company is earning $1 a share in profit and they're paying out 40 or 50 cents in dividends, then there's quite a margin of safety there. But if the company is paying out 90 or 95% of their profit in dividends, then it doesn't take very much to go wrong for the company to have to wind back that dividend. So look out for the payout ratio as a margin of safety. And the other thing that I look for is, does the cash flow exceed the reported earnings? And if you can focus on companies where free cash flow is greater than the reported earnings, then that's a sign that management is running that company very well and very efficiently. Where dividends can go wrong, a high dividend, something that's maybe paying 8, 9, 10%, often goes with a very deflated share price. And the share price may be deflated because it's signaling major trouble ahead. The market is a forward-looking pricing mechanism. And if they think that a company is going to struggle in the future, then the share price gets marked down significantly. The dividend may look attractive, but the dividend in the future environment may not be sustainable. So just be very careful about chasing high dividends. Because, as I've said before, the company can reduce or even suspend them. Some companies borrow heavily to pay dividends, and that's a recipe for disaster, particularly when we are going into what looks like a rising interest rate environment. And some companies' dividends don't keep pace with inflation. Telstra is a good example. For nearly a decade, Telstra was paying the same dividend, 14 cents every 6 months. And so investors that were getting that dividend were basically losing money relative to inflation. So they're all the things that you need to consider with dividends. Now, I just want to cover covered calls, just touch on it very briefly. This may be a process that you don't have any understanding of, and I'm going to cover that in future video. But it's more conservative than just owning stocks is the first point. So if you have any predispositions or biases about the options market, then may I suggest that you toss them out the window because they're probably not valid. If you buy options, then that's a great way to lose money. And that's what most people do, and that's where the options market gets a bad rap. But if you stand on the other side of that transaction and you sell options to other people and collect money for doing so, then that is a very good way to generate additional income every month, or even in some cases every few weeks. Now, there's a whole range of different return levels that you can target, and the options market gives you the ability to basically dial up or dial down the return and the volatility level. The benefits of using covered calls is that time decay works in your favor every single day, and that's a huge benefit that you don't have with just owning stocks. It allows you to progressively reduce the purchase price of the stock. And for standard US blue chip stocks, you can very easily get 1.5% per month premium on a whole range of US stocks. So that's a very, very attractive return. And if you know how, anything even up to 4% a month is available in more volatile stocks and ETFs. But I will cover that in more detail in a later video. For the next few years, the things that you need to think about is the S&P 500 trend and character intact, and I looked at that earlier, and at this point in time, at the time of recording this video, it is still intact, and so we can only go forward with what we see at the moment. You want to identify the strongest growth sectors in the available markets. And these come in, I guess, in two distinct categories. One are the sectors that are already in a strongly established trend and where the fundamental drivers are very, very powerful for the future. And that particularly relates to technology and Chinese internet stocks. The second category are new trends that are just getting started, where the drivers for the next 3 to 5 years are very strong, but that trend hasn't really caught hold yet. But that doesn't mean that you can't judiciously start to build your investment into those sectors. Once you've identified the strongest sectors, just forget about the rest of the market and just focus on finding the best stocks with the best fundamentals in those growth sectors. Next, only buy the dips to where there is likely support. Likely to be. That doesn't guarantee you a particular outcome, but it certainly does tend to enhance your return. And then you actively manage them. You take partial profits when prices become extended, and you only add what has just gone through a dip. So if you can retain that discipline, then you've got the potential to do very well in the market. Now, what's coming up in the next video, I'm going to be looking at the best way to diversify, the inefficient way, the very dangerous way, and then, of course, on the other side, the intelligent way. And I'm also going to be looking at how short-term perception provides both opportunities and penalties. And I'm going to be looking at some of the world's biggest companies as examples. Now, if you'd like to discuss this info further, or you want some clarity around how you should approach your own trading and investing, then here's my contact information. I'd love to hear from you, so please let me know if you've got any questions or you require some assistance. That completes this video, and I'll be back with you shortly. Cheers.